Hello everyone, and welcome back to the channel. Today, we're diving deep into one of the most important topics currently shaping the global economy, the US-China trade deal. The US and China have reached a temporary 90-day pause on tariffs, and now we're going to break down what's next, how the tariff reductions are going to impact industries, and what this means for global markets in both the short term and long term. In this video, we'll cover 4 key points. First, the post-90-day outlook. What can we expect after the pause? Second, the tariff reductions and how they'll affect industries and consumers. Third, the global impact. How will this affect countries outside of the US and China? Fourth, the short-term wins and long-term risks. What's at stake moving forward? Make sure you stay tuned to get the full picture on the future of global trade and what's ahead for both the US and China. So, what happens after the 90-day pause is over? That's the big question on everyone's mind. This temporary truce between the US and China gives both countries some breathing room. But it's clear this pause is not the end of the story. The pause offers a chance for further negotiations and possible reduction in trade barriers, but there are still unresolved issues. One of the key aspects of this deal is that the two countries have agreed to continue discussions. But after the pause ends, if no significant deal is reached, tariffs could return, potentially at higher levels. The focus will be on structural changes to address the trade imbalance between these two economic giants. And for that, the 90-day window will be crucial. How both nations handle this pause will determine if we see a new trade order or a return to heightened tensions. There's no question that the global economy is watching closely. Now, let's talk about what tariff reductions actually mean for industries. When the US decided to lower its tariffs on Chinese goods from 145% to 30%, and China did the same, reducing tariffs from 125% to 10%, the immediate effect on industries and consumers is significant. Let's start with consumers' tariff reductions directly lower the prices on a wide range of goods, including electronics, clothing, and consumer goods. A reduced tariff burden means cheaper prices for everyday products, Apple, Dell, and even automakers who rely on Chinese-made parts could see price drops in their products. But what about the industries? For sectors like technology, automotive, and pharmaceuticals, these tariff reductions bring major relief. For example, tech companies that rely on Chinese components or assembly for products like smartphones and laptops are likely to see lower production costs. In return, that can lead to higher profit margins and increased consumer demand. But it's not just about consumer goods. US manufacturers could benefit from cheaper Chinese raw materials and components. Companies that rely on steel, aluminum, and other goods produced in China will see reduced production costs, and this could lead to an increase in production and even job creation. The US and China are two of the world's largest economies, but the effects of their trade deal go beyond these two countries. How does this agreement affect the rest of the world? First, we have to consider the impact on global supply chains. Countries like Mexico, Germany, Japan, and even India play crucial roles in the global production network. With reduced tariffs between the US and China, countries that act as intermediaries in the trade process will benefit. For example, Germany, a major exporter to both the US and China, could see increased exports due to more stable trade relations. Similarly, India, which is growing as a major manufacturer and supplier of electronics and automobile parts, might benefit from a more predictable and cheaper trade route. But it's not all positive. Developing countries that rely on cheap Chinese imports may face price increases as the US-China trade relationship shifts. Countries like Brazil and South Africa will have to navigate new trade relationships as tariffs change and competition heats up in key markets like agriculture and energy. So far, the tariff reductions seem like a short-term win for global markets. Financial markets have reacted positively, with major stock indices seeing increased gains in response to the easing of tensions. But what's next in the short term? We're likely to see increased economic stability. Businesses will have a clearer understanding of their costs, and that could lead to more confidence in investment. The U.S. stock market has already shown signs of recovery, and this trade deal could lead to economic growth over the next few months. However, the long-term risks are significant. If the underlying issues that led to the tariff suck as intellectual property theft, technology transfers, and trade imbalance are not addressed, we may see increased tariffs down the road. Additionally, the agreement is built on temporary terms, which means that once the 90-day window closes, we could return to square one if deeper structural issues are not resolved. It's also possible that countries will feel compelled to impose their own tariffs or retaliate in other ways. To sum up, the U.S.-China trade deal is a critical turning point in global trade relations. The 90-day tariff pause gives both countries time to figure out how to address long-term trade imbalances. Industries are already feeling the effects, with some sectors seeing immediate benefits from tariff reductions. But the key takeaway here is that, while this is a short-term solution, the long-term stability of U.S.-China trade relations is still uncertain. Will the two countries find a way to truly resolve their differences? Or is this just a temporary fix? We'll be keeping an eye on the next steps in these negotiations. For now, make sure to subscribe and stay updated on the latest developments in global trade and economics.